I'll start off by saying I'm not the type of person who listens to earnings calls very often, just not where I live. I don't pick specific stocks professionally or personally. So listening to earnings calls is generally not my favorite use of my own time. I got flagged via Twitter that the Q4 2021 earnings call for Restoration Hardware was interesting and unique and out of the ordinary.
It was spicy, to say the least. It was
spicy. Yes. The upshot of it, I would say, is that this company, which grew, 30 or 35% in the last quarter, guided downwards, meaning that they changed their outlook for future sales and growth downwards to single digits, which I think was a huge surprise for the market. And they cited extreme difficulties with delivering and getting things done for their customers. They cited costs going up. They cited length of time to get stuff done. And they cited difficulty on the consumer's balance sheet, resulting in a lower, basically in Q1, they've seen lower sales, lower traffic, lower volume. And this was, again, a surprise to the market, I think. And the rest of the call, so they have like prepared remarks at the beginning. They read a nice thing about, hey, we love our strategy, we love our brand, yada, yada, everything's going great. But here's these headwinds that are a little bit scary. And then the rest of the call was analysts kind of pestering the CEO with questions about, hey, what does this mean? And how bad is this? And he said a few things that were very jarring. At one point, he mentioned The Big Short, which is not something that most CEOs mention in most earnings calls. But again, the upshot's the same. He's worried. This is a billionaire CEO with a bunch of stock who is very worried about the consumer in the US. He's very worried about inflation. He's very worried about supply chains not being functional and huge cost increases coming down the pike still to come in the US, which is funny and a little bit counter to some narratives that we've heard, which is that these supply chain issues are maybe fixing themselves. Maybe they're evening out. Maybe they're getting back to normal. At least one person's view from the top is no way, not even close.
But the truth is inflation is like killing the American consumer. It really is. I've talked to several people and they're like, yeah, my raise did not cover for the increase in costs. Like my food costs are up, 50%. These are people who are also like, having kids and stuff. And so, that it just exacerbates like the entire situation. I look at my personal situation. I'm trying to buy a house, and if I've used my current assets, right, for the down payment, and using home prices of, when the pandemic started, I would have probably bought my forever home. Now I'm probably gonna have to buy a starter home and probably, sacrifice a lot of things on the wish list. I think the situation where you could buy a forever home as your first home is kind of unusual. I would say most people buy their starter home and then move up within like 7-10 years.
So you agree generally with this, the timing of this and the outlook. I think that if you were to summarize it, the upshot is he says now is the time to exercise caution. Now is not the time to be super aggressive. The American consumer is cautious. We need to be cautious with our balance sheet, with our strategic initiatives. Now's not the time to get caught over your skis. Cited a lot of historical examples. So generally, do you think you agree with that take that now is that type of time? At least strategic, like consider yourself an operator, right? A business owner, more so than maybe an investor.
I think so. I mean, how old is he, the CEO? I forget.
It's like 62.
Yeah, and he's been a CEO for the last, 20
decade.
Years? 10 years?
I think a decade, yeah.
I thought it was more, but you might be right. So I really do think that from if you're a luxury discretionary consumer company, yeah, you ought to be quite careful. Like that's the fact. So I just want to share here on the screen we have consumer sentiment. I took this from a Bloomberg article that was actually published on March 25th, 2022. And the title of the Bloomberg article is U.S. consumer sentiment remains at a decade low on inflation and war. And so what it said specifically is that the problem is the consumers still expect a ton of inflation coming through, and the Fed's raising rates. It basically said that they're worried about their living standards.
Yeah. Hard to grab positive stuff out of the headlines right now.
Yeah.
This is one of those charts that reminds me of, and inflation we've talked about a lot, but I don't know what it was, but it was a few years ago that I realized that inflation is not just like this linear phenomenon of just like, all right, there's dollars, there's spending, there's costs, and you can just like measure it and figure it out. There's a big reflexive psychological piece of inflation. It's sort of like, it just like the more that it gets said, the more that it gets talked about, the more important it is. It's just an important, I think, just like psychological benchmark for people. Like how often has the median consumer heard the word inflation over the last 3-6 months? As that goes up, that has effects on behavior, which is self-reinforcing to the actual phenomenon of inflation. So yeah, not surprised to hear this. And I think my overall take is that I do agree with the outlook of Mr. Friedman, the CEO of Restoration Hardware, and consumer sentiment right now. I get it. I empathize for sure.
This real Fed funds rate is negative right now, and usually if you have CPI at 2%, let's say, and we're entering a recession, usually the Fed funds rate goes down to 0, right? Usually after a recession or during a recession, real Fed funds rate, they push it down to 0, right? Because the idea here is that you should invest, and as a result, they push the rates down, right? So normally, let's say the rates are 5%, inflation is at 2%. When the recession hits, they lower the Fed funds rate to 2%. They match inflation. The real Fed funds rate goes to 0. But in this case, you're so negative. So there isn't much you can do. You can't cut. I mean, the Fed can't cut rates if we have a recession.
Why this can go? We're rewriting new monetary policy rules in real time. They could go crazy. Like there's negative nominal.
Yeah, but the rates shouldn't be, that I think that drives inflation. And you look at all the periods where you had that, and that's kind of where periods of inflation were.
I don't know this because I don't follow macro stuff generally, but my impression is that Japan and the Eurozone have been even more aggressive than the US in terms of QE and negative real or nominal rates. Have they been punished for this? Is the inflation story similarly bad in Europe or Japan?
Wages in that case, in the U.S., the entire wage situation is super tight. So was Japan in a sense. Their unemployment was very low for a long period of time, but they never had wage growth like we had. And this is the second graph where he talks about, and in Europe the same. Europe, they never had a very, very tight labor market. This is kind of wage growth right now. Historically, what he said was that wage growth and the Fed funds rate usually tracked each other. They kind of like, look at the peaks, maybe not in 1989, but look at the peaks of 1998 and 2008. They kind of match each other. And like here you have the wage growth going up to like 4.5%, and you still have the Fed funds rate like way behind. You've heard of like all the employees like fighting to go back to the office. Nobody's going back to the office. And like as a result, like employers are too afraid to request people to go back to the office. There's only one reason why people will go back to their office. It's they fear their employer. They'll get fired. Right. And when do they fear their employer? In recessions.
Okay. So the pendulum swinging in another direction is what you're saying.
I think eventually like we're gonna have, but this is not the reason for a recession. The reason for a recession is like consumers are gonna stop spending once the food costs and energy costs starts to like take over.
The pocketbook gets stretched. That's what causes it.
Yeah. And mortgage rates at a higher rate right now I mean, it's only going to affect the newer home buyers, right? Until it actually rates go down. But like, let's say rates go up, mortgage rates go up to like 5-6%, right? It will force new home prices, or all home prices probably to go down a little bit. We still don't have enough inventory of homes in the US available, right? So it's still going to be pretty tight. It's going to take some time. But once that starts to build, once the home inventory start to build, then prices will start to inch down a little bit to be able to maintain that level of affordability, that equilibrium that existed before this. And that's going to, like, between mortgages, food costs, and energy costs, we will have a reset of the consumer. One last thing. Do you think we're going to go into a recession in 2022 or 2023?
Truly do not concern my mind with it. If I had to guess, gun to my head, I would say yes. It's not an estimate. It's not a model. It's not a projection. That is truly a guess.